Areas of supply and demand are the number one piece of information you need to know if you are trading smart money concepts. So in this video, I'm going to show you everything that you need to know about supply and demand zones and the 3 different types that there are. But this isn't going to be your typical video where I run over general concepts and give you the basic information. I'm actually going to give you a sneak peek of the lecture style education that I do within the trading floor so that you guys have a better understanding of how that is structured, as well as to find out if that is actually your preferred method of learning things. Okay, so now that you guys have a clear understanding of market structure as well as how the smart money moves in their order flow, I want to now discuss supply and demand zones. When smart money starts moving huge amounts of capital around, and say they're selling off the market, it's not all financial institutions all doing the same thing. They're all fighting against each other. They're all trying to make the most amount of money. They're making the market move in dramatic ways. So as you can see right here, this was the initiation of it. Buy orders starting to fill up the price back to where it was. And then the banks get in again, sell off the market, and you start getting these cascading effects down. Every time one of these large spikes in these zones happen, these are known as supply zones, where the supply is high so that the smart money can sell off their positions. It's the same concept of supply and demand in everything in life. Whether you want to buy a car that's extremely rare, so the supply is very low, but the demand for it is high, so the price goes up. Anyway, anytime these large spikes happen in the down direction, the bearish direction, these are known as areas of supply. Anytime these spikes happen in the upwards direction, these are areas of demand. Again, thinking about multi-time frame analysis, higher time frame levels of demand hold more significance in the market and are areas to keep in mind when looking for rejection zones. So there are 3 types of supply and demand zones. A range supply shows the entire range of that last impulse to the upside that swept liquidity and came down. You can see that depicted here in these 3 candles. Marking this entire area up as your supply zone and using the bottom of this zone as your entry, you can clearly see will give you a nice trade, but a lower risk to reward because your stop loss needs to be above this supply zone. The next way to draw a supply zone is the pivot supply. It is simply the last bullish candle before the bearish candle that showed the pivot point. Using these types of supplies will get you a higher risk to reward. Now, a fractal supply zone is simply looking at the top wick of that bearish movement. And if you use these as your supply zone markups, your risk to reward is extremely high, but the chance of you being tagged into a trade is much lower. So you will miss some trades with fractal supply zones. So as you can see here, once price hit this higher time frame demand, it shot up, breaking previous supply zones. Once it broke a previous supply zone and came down and rejected up, that is now a new demand zone. So the supply zones push the price down into a higher time frame demand, and then the lower time frame demand zones push the price up, filling in all of these supply zones. Now I want to break that down just so you can see a little bit clearer. A range supply zone takes the entire range up before the price rejected down. This zone is where you want to look for sell orders. You can see as price came in here, tapped it, and cascaded down. The pivot just takes into account the last candle. It's a little bit smaller than the range zone and gives you a really good risk to reward ratio. Getting in here, taking the trade down to here. If you're only looking at fractal supply zones, you're only taking into account that top wick right here, and you can see price did not come back into this zone to tap you into your trade, and you missed the movement down. Most smart money concepts traders choose pivot supply and demand zones. Now, continuing on with supply and demand, there are 3 primary areas of supply and demand. There are 3 specific areas of demand zones that are depicted here. We have the STB wicks, which is the sell to buy wicks, the inside bar, and the large wick. I'm going to explain each one of these individually. So this is a higher time frame movement. Think about how a candle forms. Price went up, this was its high point, and came down and closed right here. This next candle opened and price pushed down before rejecting and going up. So if you zoomed into this on a lower time frame, you would see something similar to this. Price came up, pushed down, and then continued. So these 2 wicks tell a huge story on which direction price wants to go. and this demand zone that was created here. So from the top of this wick to the bottom of this wick, or sell to buy wicks, demand zone. Next up, we have the inside bar. An inside bar on a higher time frame, if you zoomed into a lower time frame, would be a short ranging price before price continued up. Then we have the large wick. This large wick right here on this higher time frame is very clear, but on a lower time frame, you will see price come down, reject, retest, and continue up. All three of these are on higher time frames. Looking for these and identifying these on higher time frames is extremely valuable, because then once you zoom into a lower time frame, you will see a clear story of what's happening here, and you will be able to use these demand zones as your entry prices. Conversely, looking at these exact same examples to the sell side, we have BTS wicks, which are buy to sell wicks, showing a supply zone on a lower time frame. The inside bar, again showing a ranging market on a lower time frame, and large wicks. All the same examples that I showed you in a bullish market depicted here in these bearish movements. Now let's discuss institutional supply and demand zones. Institutional supply and demand zones always happen on the higher time frame because, as I said before, the higher time frame market structure holds much more significance and relevance to what direction the banks, financial institutions, and smart money are moving their money around. The more significant the structure, the more significant the zone is. So when you see higher time frame breaks of structure, that is the most significant. When you see price reject and go up to break a previous high, that is now a confirmed demand zone. And you will draw up this demand zone, wait for price to come back into it, and then enter your trade here. You don't want to enter the trade here or at the top. You want to wait and be patient and have price come back into that demand zone, which is also a discounted zone if you think about this price movement up and the 50% level. This is the only half of this area that you want to get into. Conversely, on the sell side, if price had a swing that broke previous structure, that is now a valid supply zone, and you can mark it up and wait for price to come in here on the higher time frame, and then look for your laser entries on the lower time frame. So the orders of significance is a break of structure, and then going down to a medium time frame, internal breaks of structure, and then the lowest time frame is where you're going to find your change of characters. That's going to happen right here. You will see a small change of character near this supply zone, and that's where you want to look at entering your trades. Then flip zones indicate when the smart money is moving price in the opposite direction. You had a clear downtrend breaking structure. Price came up to break the higher time frame structure and break through the supply zones. Now validating this as a valid demand zone, wait for price to come back, enter in this demand zone, and follow the new trend that has been formed. When you're looking at institutional supply and demand zones, you only want to focus on zones that lead to breaks of structure. This area led to a break of structure. This is what you want to focus on. This broke structure. This is what you want to focus on. Now, let's put some things together. Let's layer on supply and demand with market structure. As you can see, market structure making higher highs and higher lows right here. Each movement up broke previous structure. So once one of these movements came up to break structure, it then created a demand zone. So as price comes down into it, you buy at these demand zones, which subsequently are in areas of discount below the 50% level. Then once price starts reversing and breaks the previous up structure, that is your new protected high. So as price comes down, creates new bearish market structure. This move broke the previous market structure right here. That is now your new supply zone. Price came back into an area of premium as well as that area of supply and made a new lower low. Once price breaks through that supply zone, it will then create a new demand zone once it breaks that structure. This is also known as a flip zone, which we'll go into more detail later. I really hope you guys enjoyed that video. I hope you learned something from it. If you're interested in seeing the rest of the course, just sign up to the trading floor, linked down below. Or if you'd like more videos like this on this channel, just let me know in the comments section. Thanks so much for watching, and we will see you in the next one.